Introduction to Working Capital. Working capital is the lifeblood of any business. It represents the operational liquidity available to meet short-term obligations and daily operating expenses. Efficient working capital management ensures a company can maintain smooth operations while minimizing the cost of holding excess resources. Definition: working capital equals current assets minus current liabilities. Positive working capital means a company can pay its bills and invest in its operations. Negative working capital indicates potential liquidity problems and possible insolvency. Components of working capital. Understanding working capital begins with breaking down its major components. A. Current assets, cash and cash equivalents, immediately available funds, accounts receivable, money owed by customers, credit sales, inventory, raw materials, work in progress, finished goods, marketable securities, short-term investments, prepaid expenses, insurance, rent or services paid in advance. B. Current liabilities, accounts payable, amounts owed to suppliers, short-term loans, borrowings due within 12 months, accrued expenses, salaries, taxes, utilities due but unpaid, notes payable, written promises to pay money in short term. Efficient working capital management strikes a balance between liquidity, ability to pay, and profitability, avoiding idle resources. Types of working capital. Gross working capital, total current assets of a business. Net working capital, current assets minus current liabilities. Permanent working capital, the minimum level of current assets is always required. Temporary working capital, the excess of current assets needed during peak seasons or special business cycles. Importance of working capital management/liquidity management. Ensures the business can meet day-to-day expenses. Profitability, improvement. Efficient inventory and credit management reduces costs. Creditworthiness. Adequate working capital increases a firm's credibility with lenders. Operational efficiency, smooth flow of production and services. Business continuity prevents stoppages in production or service delivery. Working capital cycle. Operating cycle. The working capital cycle, WCC, represents the time taken to convert net current assets and liabilities into cash. It begins with purchasing raw materials and ends when cash is collected from sales. Cycle. Cash, inventory, sales, accounts receivable, cash key components, inventory, period, time stock is held before sale, receivables, period, time customers take to pay, payables, period, time taken to pay suppliers, formula, point WCC equals inventory period plus receivables period minus payables period, shorter WCC equals faster cash recovery equals better liquidity. Key metrics in working capital analysis. Current ratio equals current assets divided by current liabilities measures short-term financial health. Ideal ratio 1.5 to 2.0. Quick ratio, acid test, equals current assets, inventory, divided by current liabilities, measures ability to meet obligations without relying on inventory. Cash conversion cycle, CCC, days it takes to turn investments in inventory and receivables into cash. CCC equals DIO plus DSO minus DPO. DIO equals days inventory outstanding, DSO equals days sales outstanding, DPO equals days payable outstanding. Working capital turnover ratio. Net sales divided by average working capital shows how efficiently working capital is used to generate sales. Cash management. Cash is the most liquid asset and requires effective management. Objectives. Maintain adequate liquidity. Avoid cash shortages or surpluses. Ensure optimal returns on surplus cash. Cash management tools. Cash budgets. Forecasting. Lockbox systems. Electronic funds transfer EFT. Bank reconciliation. Example, period. A company maintaining a large idle cash balance may lose potential interest income. Conversely, insufficient cash can halt operations. Receivables management. Accounts receivable. Receivables represent money owed by customers. Poor management can tie up cash and increase bad debts. Objectives: maximize sales, minimize collection period and defaults key elements. Credit policies, terms, limits, and procedures. Credit analysis and approval collection procedures. Tools: aging schedule, debtor turnover ratio, days sales outstanding, DSO. Best practice: perform credit checks, incentivize early payments, and impose penalties for late payments. Inventory management. Inventory must be controlled to avoid stockouts or excess holding costs. Types of inventory: raw materials, work in progress, finished goods. Techniques: economic order quantity, EOQ. Dot. Minimizes ordering and holding costs. ABC analysis. Dot. Classifies inventory based on value and importance. Just in time, JIT. Minimizes inventory levels and associated costs. Reorder point system. Dot. Automatically orders stock when it reaches a threshold. Note: excess inventory ties up capital and increases storage costs. Too little inventory leads to lost sales and customer dissatisfaction. Payables management, accounts payable. Payables must be managed to maintain supplier relationships and preserve cash flow. Goals. Dot. Delay payments without damaging credit reputation. Take advantage of early payment discounts when feasible. Tactics: negotiate favorable credit terms. Use supplier financing. Prioritize payables based on due dates and penalties. Working capital financing: businesses may need to raise short-term funds to finance working capital needs. Sources: bank overdrafts, trade credit, short-term loans, invoice factoring, commercial paper. Important: over-reliance on short-term debt increases financial risk. Proper balance is key. Working capital policies. Conservative policy. Dot. Maintains high liquidity by using more long-term financing. Lower risk, lower returns. Aggressive policy. Relies on short-term financing for higher returns. Higher risk, higher profitability. Moderate policy. Balanced approach using a mix of short and long-term funds. Strategies for effective working capital management. Implement strong internal controls. Use technology for real-time monitoring. Create supplier and customer segmentation strategies. Benchmark performance against industry standards. Regularly review cash flow forecasts. Summary and conclusion. Effective working capital management is vital for business survival and growth. It ensures that a firm maintains the right balance between liquidity and profitability. Poor management can lead to missed opportunities, strained supplier relationships, and even bankruptcy. A company that masters cash, inventory, receivables, and payables management positions itself to operate efficiently even in volatile environments like Nigeria's economy. Revenue is vanity, profit is sanity, but cash is king. Old business adage.